Indeed, Mike, stay right there. As our next guest is striking a cautious tone on the markets, expecting the S&P to end the year roughly around where it is now at 4,400 and hold there through April 2024. But he does see some positive signs, including a resilient consumer. Let's bring in Barry Bannister. He's chief equity strategist at Stifel. Barry, it's great to see you. I said you were a little cautious, but compared with some of the outlooks out there, I'd argue you're almost optimistic. So what keeps us out of a worse performance in the S&P in the near term?
Yeah, the S&P did pop up the couple hundred points that we expected in a note we wrote over a little over a month ago at the end of the September correction. We've really not been too interested in the S&P top line. We think the index itself is peaking out. The mid-single digit, high single digit earnings growth into 24 would be offset by a little bit of multiple compression. The price earnings multiple would come down. So what we've been emphasizing is more of a cyclical value, prolonged cycle trade, and less of a cyclical growth. So think of that as long financials, industrials, energy, basic materials, real estate. And then on the short side, on a pair trade, some of the semiconductor early cycle cyclicals like NVIDIA, Apple in computer hardware, as well as autos like Tesla.
You know, you know better than anyone how much you're sticking your neck out on that kind of call, Barry, because for starters, it's something people have been expecting for a long time. But also, there's the risk that the liquidity and momentum trade picks back up with some, like we said, Apple's up 8% this month. So what gives you the confidence to stick with this and make this big call that people are going to rotate into cyclical value?
Well, most of those big cap stocks are the reason we did have a rally back from 4,200 or 4,150 on the S&P 500 at the bottom of the correction recently in September to 4,400. But I do think that the market stalls out here. If you look at it, the economy is still sailing along fairly well. We came to the precipice of an unemployment signal of recession, but our leading indicators in unemployment indicate actually a pullback in unemployment in the next few months. The consumer is still quite well. Real goods consumption, these are tangible goods, have been rising above trend, above the 10-year pre-COVID trend now for a couple years. And the services have reconverged on their pre-COVID trend. So that's less volatile GDP. So when you think about it, the economy is holding on pretty well, and rates have topped out. Inflation is somewhat sticky, and that puts you more in that cyclical value camp where they're oversold.